Good morning. This is Larry McMillan with a stock market update on Monday, January 22nd. So S&P has broken out to a new all-time high, both closing and intraday on Friday. It's adding to those gains today. And so the S&P chart is quite positive, and for that reason, we are still holding a core bullish position. Internally, things might not look as good as the chart itself does, but that's always a potential problem for the market. Usually, it overcomes it. I mean, it's always people talk about the Nifty 50 back in the 1970s or other times when just a few stocks were carrying the market. This might be one of those times, but that doesn't necessarily mean the market's going to go down or even have a major correction. We've just gone sideways for a month, and that sideways area, which extends from roughly about 47.40 all the way up to 4,800. I'm sorry, 46.40 all the way up to 4,800. That's a support area now, so that should provide some relief if the market were to have a minor correction here. If we fell back below the January lows at 46.40, then that would be a negative move. But that doesn't seem like that's going to happen anytime soon. Meanwhile, the equity-only put-call ratios remain on sell signals, and many individual stocks' put-call ratio charts are also on sell signals. So this is part of what I was talking about. Individual stocks, many of them are not looking as robust as the S&P index itself is, and it's possible, that some of these stocks will go down even though the index is going up. Breadth had been very negative, again reflecting poor performance amongst individual stocks, but that's now improved with Thursday and Friday's action, and we're on the verge of a new buy signal from breadth. Similarly, with new highs versus new lows, we had more than 100 new highs on the New York Stock Exchange on Friday, and that's a positive sign as well. If we get 100 again today, that would be a new buy signal from that indicator. Meanwhile, the volatility indicators are generally bullish, especially those involving VIX. VIX has remained fairly depressed. There was a little rally last week and went up and touched its 200-day moving average, but it didn't close above it. And so the trend of VIX is still downwards, and that's bullish for stocks. We can say the same thing about the construct of the volatility derivatives, the futures and the options. Again, they're painting a bullish picture for stocks. The warning sign, the minor warning sign would be if VIX were to close above its 200-day moving average. The major warning sign would be if the now front month February VIX futures were to rise in price above the March VIX futures. That doesn't appear to be anywhere close to happening, but that's something that we always watch for. So we are entering at the end of this week, beginning the end of this week, a strong bullish seasonal pattern also exists. So we may get a push up into February, and then February has been a bad month a couple of times in recent years. 2018 and 2020 both come to mind. Pretty nasty corrections took place there and into March of those years. So we'll be paying attention. We roll our long positions up as they become more deeply in the money, but we are maintaining this core bullish position, and we will trade these other indicators around that core. So I invite you to visit our website, take a look at our newsletters, and meanwhile, have a great week trading.